Okay, so we're going to shake it up a little bit. No more presentations, just conversation, just Q&A. And I've got three of the smartest guys in Miami to talk about business perspectives. Come on, you're not going to let me down, are you? Business perspectives in Latin America. I've got Ed Glab here, and he's already introduced himself. Ed Glab's Mr. Oil, Mr. Energy, former ExxonMobil executive, now runs the Energy Forum at FIU, where he's a professor. I've got Eric Bethel here. Eric Bethel runs the Latin American private equity practice at Darby Overseas Investments. He used to run a company called Sino Latin Capital based in Shanghai, and arguably knows more about Chinese Latin American relations and business relations than anybody, certainly in this town. And John Price, I'm sure most of you have seen John speak before. John runs a company called America's Market Intelligence based here in Coral Gables, and with eyes and ears all over the region. One of the smartest business analysts around. So with that said, I'm going to jump in and ask these guys some questions, and I'll tee it up for them, and they're all welcome to respond, and hopefully mix it up. And then you guys are all invited also to jump in. Not right away, but I'll give you the signal, and then we can have a broader discussion with the audience. So we heard from the first panel that Latin America is really not doing as bad as I thought they would say, actually. But I mean, if you think about it, Brazil's in recession, third year in a row, according to Catherine. Argentina's in stagnation. Chile's in a slump, and so is Colombia. Mexico is anemic growth at best, and there are some bright spots. But I'd like our experts here to start out on a positive note, and let's focus in on business opportunities, interesting business bright spots in the region in 2016. And I'm going to start with John Price. John?
Thanks, Ian. Before I address those, remarks, I'd be remiss if I didn't take just a moment to thank Susan and Susie for all they've done for this town. A decade ago when they started this venture, I said at the time that they had raised the intellectual discourse of this city by, at least when it came to Latin American issues, by many-fold, and I think that they've proven that time and time again. So thank you both for including us in this venture of yours, and all the people that you've brought into it. I tend to be a bit of a contrarian, and this is probably, I think, the fourth cycle that I've lived through studying Latin American markets since 1993. And what is different about this time is, in the past, what I found was that Latin American divisional managers struggled to convince their bosses in the US, in Europe, and in Japan and Korea, et cetera, that Latin America would bounce back and that now is the time to invest. And at the time, it was probably difficult to make that argument because Latin America, for a lot of companies, was 3 or 4% of their global sales. Perhaps those divisional leaders were not the best and brightest in the company because the stakes of Latin America, frankly, weren't the most important in the global footprint of that company. But that all changed over the last 12 years. Latin America is now a much bigger footprint in the global economy and an even bigger footprint in the sales and profits of global companies. And the people running the show are of a different caliber. And this time round, interestingly enough, I think the Americans in particularly have learned that now is the time to invest, and there's actually a greater level of optimism around Latin America in the sort of global boardrooms than I would have expected, and more pessimism in the sort of divisional executive suites than I would have expected. I think that many of the markets, and I don't want to rehash what was said earlier, but we all know, or we all anticipate, a difficult year ahead in places like Brazil and Colombia and Chile, Peru, a difficult year of transition in Argentina. But Mexico and Central America and the Caribbean are long through their recovery, and they're on full growth pattern. And cheap oil for most of those markets is a real boom. I mean, for all of Central American, Caribbean countries, they are really heavily weighted by high oil prices and what it does to their terms of trade, and liberating those monies. There was an interesting statistic put together by the IMF recently that said, okay, because people said, well, if the price of oil drops, then the Petrocaribe support for Venezuela is going to go away. Well, that support is a fraction of the positive effects of cheap oil. So even without Petrocaribe support, these countries will benefit from cheap oil. And then in terms of Mexico, Mexico was slow in realizing its potential of the new government. Peña Nieto took 2 years to push through his reforms, and in doing so, really purposefully stagnated the fiscal spending in Mexico and put on hold the investment wave that typically comes within 12 months of a new president in Mexico. But that's now moving forward. And more importantly, a third of Mexico's economy moves in sync with the U.S. economy. And the U.S. economy, no matter what happens in Washington, no matter the buffoons that they roll out in front of us during the different campaigns, is booming. This country's private sector has never been stronger. And our utilization of our manufacturing sector is as high a level as it's ever been, which means that there's a huge spillover effect on Mexican manufacturing. And that's pulling up Mexico. So Mexico's firing on many different cylinders, and you will see positive growth, increased growth in all of those areas: Mexico, Caribbean, and Central America.
Hey, Eric, you want to address the bright spots?
Yeah, I mean, to be honest, the growth deceleration that you've seen in China, and supply side imbalances on a number of fronts has hurt commodities. And as we all know, at the end of the day, Latin America's core exports are commodities. And as commodity prices have fallen, coupled with the strength of the dollar, just about every country in Latin America has been hurt. So it's really tough to see bright spots the way you would have seen them in, say, 2010, right, where everything was looking pretty rosy. Having said that, I'll agree with most of the points that John made, and I'll add to those. We as a private equity fund are investing, and we've been investing for the last 20 years in Latin American companies, and the caliber of people that we're investing in today is far and above greater than it was 10, 15, certainly 20 years ago. 20 years ago, Latin America, the private sector was dominated by family groups with corporate governance standards that weren't, let's say, global, world class. And today, you're seeing companies that are run by younger people. B, very U.S. or European, very well-educated people. The caliber of the boards has gone up. So when we look to invest in Latin America, we're not just necessarily looking at whether the macroeconomic factors are stable or not. Clearly, that's important, but also we're investing in people, and the caliber of the people have gone up, and that's certainly a bright spot. With respect to I won't get into specifics on Latin American countries, but I'll give you an anecdote, right? Let's look at Chile. Chile is obviously suffering from low copper prices, which is the country's leading export. So when copper prices go from $4 to $2 a pound, $2 is roughly where they are today. The currency devalues, the economy slows, and so forth. But there's a natural hedge, right? As the Chilean peso devalues, there are other sectors of the economy that do very well. Take, for example, the agriculture sector, right? So if you are, say, a blueberry export, and Chile is, interestingly, one of the largest blueberry producers in the world, and you're selling a product that's denominated in dollars, yet your costs are in local currency, you're actually doing pretty well. So there are bright spots here and there, and those are the things that we're looking to invest in.
John mentioned that in this counter-cyclical approach to Latin America, that the head offices are really interested in investing in Latin America. And is that the case with Darby? And is it easy to sell Latin America at this time? I mean, asset prices are low, currencies have never been lower. Is it a good time to invest in general?
Yeah, I mean, the short answer is yes, right? I mean, how many of you have heard your grandmother say, or buy low and sell high, right? I mean, this is simply one of the best. The two sectors that have been hurt the most globally have been A, emerging markets, and B, commodities, broadly speaking. And it's a double whammy for Latin American companies. You can look at some of the public stocks like Vale, for example, in addition to their other issues with a dam spillage and so forth, but or Rio Tinto. You can look at some of the large public comps, but then at a private side, we're seeing valuations and valuation expectations plummet. So for us, this is arguably the best time that at least I've seen in 20 years to invest in Latin America.
Wow. Okay. You know, since we started this morning, we've been talking about oil and energy, and John started off as well talking about oil. It's the one big story of this year. And Ed, I already told everybody you're Mr. Energy and you're Mr. Oil, so set everybody straight on the oil price. Where is it going over the next 12 years, and how is it going to impact the region? 12 years, 12 months. 12 days is hard enough, 12 months.
12 hours.
I don't make predictions. About a year ago, Susan had this conference. She invited me, and what I said was that history might not repeat itself, but it certainly does mumble a lot. And what I meant by that in a paper that she later published based upon my comments at that conference was that the period we're in right now very much reflects what happened in the 1985-86 period when oil prices also collapsed. Now, how long did it take for oil prices to recover in the wake of the mid-'80s oil collapse? The answer is 14 years. 14 years. Now, I'm not predicting it's going to take 14 years for oil prices to get back up to pushing $100 a barrel. However, what I am saying to you, and this is the same thing I said in the paper, that all of the data, every last iota of data that you can point to suggests that oil prices are going to stay low. Now, what is this data? First of all, number one, the world currently produces about 2 million barrels a day more than there's a demand for. Now, what does that mean? That means that currently global inventories of oil are at the 3 billion barrel level. They are growing. This year, they grew on average at about 1.5 to 1.75 million barrels a day. In the last quarter of this year, inventories grew by 1.4 million barrels a day, and even into next year, first quarter prediction of the Energy Information Agency is they're going to continue to grow by 600,000 barrels a year. Inventories in the United States are at all-time highs. They have not been this high in 80 years. Nearly 500 million barrels of oil, and that inventory also continues to grow. There is 5 million barrels of spare capacity in the world to make up for any country whose oil exports might be affected. Iraq's oil production over the last year to 18 months has increased by 1 million barrels a day. Iran, once the sanctions are lifted, is going to be able to put into the market within a very brief period, I'm talking about a couple of months, 500,000 barrels a day, and within about a year, as much as 1 million barrels a day. So I would like to know what are the factors, and I haven't completed the list, by the way, because we also have the energy efficiency that increases every day with new technologies. The amount of energy we use in the world today is less than half of what we used 30 years ago to produce the same dollar of GDP. The same is true on a per capita basis of energy consumption. Also, energy demand growth in the OECD countries is flat to declining, and the engine of energy growth for the last decade, their economy has dwindled to the extent that they used to account for 2/3 of global energy demand growth. That's China, of course, that I'm talking about, and they are not doing that anymore. As a matter of fact, the commodity prices you mentioned across the board, whether it's copper, cement, steel, or oil, because the economy of China has slowed down, all of these commodity prices have begun to drop. So no matter where you look, if you look at the energy data, and I gather this stuff from the Energy Information Agency, from the International Energy Agency in Europe, from BP, from Exxon, from think tanks, from consulting firms, there's not one single thing that points to oil prices going up. There is one thing that could happen. I mean, if ISIL actually is able to somehow disrupt the Middle East. Now, what do I think is going to be the average price of oil? In my paper earlier this year and at the conference, I suggested the reference price that Exxon used for 2015 of $55 a barrel was a pretty good point. I said I thought it could go as low as 40, could go as high as 75. I was wrong on both counts. It's below 40 and it never got up to 75. But I did use that reference price of 55. According to the Energy Information Agency, this year oil will average about $54 a barrel, but they expect that to drop next year by $2 to $4 a barrel.
Okay, so Ed, give us a quick synopsis of what's going to happen in Latin America with oil at that level. I mean, it's a disaster for Venezuela.
Nothing. Nothing.
Okay.
I mean, where's Venezuela going to go with these kinds of oil prices, and who the hell is going to invest any money in Venezuela? At the oil prices this low, you can't produce that heavy oil at these kinds of prices. What's Brazil going to do? Brazil claims they can do the deep offshore stuff for $50 a barrel. I don't believe it, but with oil prices below $40 a barrel. It's the most indebted oil company in the world. They owe $127 billion. So the only
Okay, let me ask
place,
you about that. So this is called they call it the pre-sal, right? The deep offshore.
The pre-sal,
is
right.
that, and that was going to take Brazil into the big leagues.
But
It
let
was
me
gonna
make
become a producer.
let me make a
Was-
final point here that's very important.
go ahead.
Just let me finish this point. This is a critical point. You want to know where oil prices are going, and here's what the best minds think about that. Okay, oil price is going to hover around the marginal price of production of the frackers in the United States. The United States has become the global swing producer. So whatever that marginal price is, and that marginal price is around $50 or $60 a barrel, okay? That's what the price of oil is going to fluctuate around. It could go up from there, it could go down from there. And that's basically what is most going to affect that pre-salt.
Look, if I can add to that, the fact that on the demand side, the fact that you've got Google driverless cars that are going to be coming into the market at some point. You've got Tesla. You're going to have Uber. All of these things result in efficiency, and efficiency means less demand for oil. So the way we see things is pretty similar to what Ed mentioned. The consequences, however, to Latin America are actually pretty significant, right? Mexico, for example, derives 40% of its fiscal revenues from oil, 30, and Colombia is also heavily oil dependent. And obviously, forget about Venezuela and Ecuador. So in a low oil price environment where the government spends more than it earns, it's got to get money from somewhere. And I think at some point, China is going to stop paying for this, right? The credit card limit has been reached, and I think it's done. Now, the wild card, which Ed mentioned earlier, is sure a terrorist attack, right? If ISIS, we should stop calling them ISIL, right? It's defining them by their aspirations, not by the reality. But sure, if there's a major terrorist attack, a refinery's blown up, well, oil could go back up. But that's an exogenous event that no one can predict.
Okay, so this week we have one of the biggest stories, of course, is happening in Paris. There are over 190 countries going to sign a carbon emission agreement of some kind. And Susan, don't laugh. It is a big story, and I'd like to know how does it affect Latin America? I mean, if you recall, not only was Brazil the darling of the emerging markets just 4 or 5 years ago. Remember when we were talking, I mean, at this conference a few years ago, we probably could have been talking about the decade of Latin America or the decade of Brazil. And of course, it was, with its ethanol program, the darling of the alternative energy community as well. There's a bank here in Miami, an investment bank, that does nothing but invest in alternative energy projects in Latin America called Pan American Finance. So I want to know from you guys, is Latin America part of this story? Does it have anything to offer? Is it bringing new technology? Is it developing large solar and wind projects? Is it relevant at all to this story?
Propane. I want to mention this in the context of the Caribbean in particular. I just made a presentation at a conference in Aruba about alternative energy and alternatives to clean, sustainable green energy, and one of the growing products in the region is the use of propane. Which leads me to the next point about gas and gas resources in the world. If you think oil prices are low, you ought to take a look at gas prices, because on a barrel equivalent basis, you can buy gas for about $10 a barrel. So gas, there's enough of it in the world at current rates of usage to last 200 years, and gas does compete with oil in many markets. And in the Caribbean, propane is one of those areas where you're going to see a lot of growth in, particularly in Aruba and Bonaire and some of the smaller islands which cannot afford windmills, but they can afford propane. Propane's cleaner than the fuel oil that they use now. So there is a market in gas which is cleaner, or one of the cleanest of the fossil fuels, certainly cleaner than coal or oil in any form. So there could be an impact there in terms of taking some steps toward cleaner energy.
I completely agree. The question is, how do you transport gas and gas liquids from one market to another without your ship blowing up? And so what we've been looking at, interestingly enough, are transport companies, and there are lots of different types of compressed natural gas technologies that are coming out. Liquids mixed with so propane and methane sort of held together in a tank and putting them on a ship and getting them from point A to point B. But we also agree natural gas is a tremendous growth opportunity for even, certainly places like Mexico, right? Mexico has 30 trillion cubic feet of natural gas in the Burgos Basin, making them, I think, the 5th or 6th largest deposits in the world. And as you're going to start to see more pipelines going from Mexico to perhaps Central America in the future, you're going to see more pipelines coming from the U.S. to Mexico. So there's lots of gas going around. And from the standpoint of technology, one of the things that we're seeing is a lot of these old bunker fuel or diesel-powered electricity generating units are being converted to gas. And so there's going to be a big market in that. Back to your bright spot question earlier.
You're absolutely right. And there's 3 forms. One is LNG, which is liquefied natural gas, and that is not a market in Central America or the Caribbean because it's simply too expensive. Maybe as an exporter, or a transition point. But PNG, the stuff that you use on your barbecue grill, that stuff is easily transported. There are many ships, by the way, under construction, huge number of ships being built to transport PNG, which is propane, by the way. There are no ships currently that can move CNG around the Caribbean or Central America. So if you're looking at that gas investment opportunity, the play really right now is for propane. And you make a good point, exactly, that a lot of these markets have been burning fuel oil, something that can be, some of them even burn diesel. And if they were to go to propane, it would really help address a lot of the issues that will be coming out of the Paris conference.
just wanted to add that the footprint of gas deposits in Latin America is much broader and more sort of democratically spread around the region than it is of oil deposits. And so I guess in contrast to the OECD negative growth for energy consumption, you still have positive growth in Latin America as people move into bigger homes, more homes. The number of homes being built in the region is still growing very fast. Most of them are gas heated or cooled. You still have strong growth in the purchase of vehicles of all classes. And so the energy consumption in the region is still strong. What's interesting about gas, too, is coming up with ways of storing it. Because as you know, in a lot of South America, the electricity grid relies on hydro for much of its sourcing. But hydro has proven in Brazil, above all, to be unreliable in areas of drought. And so it led to brownouts and real issues. So if you're going to use gas, one of the ways to extract a little more profit out of it is to store it and sell it during those peak periods. And so you're seeing a growth in sort of underground gas storage and just looking for inventive ways to hold on to that energy source and to play the peaks. And so that is going to be a whole new growth industry as well.
Okay, so
You also mentioned, did you want to talk about ethanol or?
go ahead.
Yeah, so for those of you that are familiar with ethanol in Brazil, it's basically made from sugarcane. It's, let's call it in layman's terms, gasoline that's made from sugarcane. And Brazil it has led the way globally in biofuels like this. Now the problem is, you would think that in a low oil price environment that the ethanol business would be dead, but it's a bit more complex than that. So it has a lot to do with refining capacity. So Brazil has limited refining capacity, and there are a lot more new cars on the market. So when people buy new cars, you can bring in as much crude oil into Brazil as possible, but if you can't turn that crude into diesel, you can't power your cars. So ethanol today, hydrous ethanol, which is what's used mainly in the flex fuel cars you see in Brazil, is at its highest, it's at its peak, it's at its highest ever level. So I don't see the Brazilian, until they fix their refining situation, I don't see the ethanol business suffering. In fact, it's doing okay.
Okay,
Yeah, it's not going to suffer. It's not going to suffer. But Brazil, last time I looked, was importing about 850,000 barrels a day of product because they don't have the refining capacity, and that's
of gasoline, right?
Gasoline, yeah, basically gasoline. They don't. Well, diesel also, yeah. Automotive fuel. Let's put it that way. That's pretty much what they're importing. But in terms of ethanol and the outlook for other countries in the region becoming in any way significant ethanol producers, it's zero. There was a big study done by the World Bank several years ago, and what they pointed out was that Brazil is unique in the world in terms of its climate and its ability to produce 2 or 3 sugar crops a year. And the cost of ethanol in Brazil is a fraction of what it is in the United States. And producing ethanol from corn makes no sense whatsoever. You have a net energy loss. I know the corn industry doesn't agree with that, but they're flat out wrong. And also, when you burn ethanol, you also get CO2 out of the tailpipe. A lot of people are under the mistaken impression that ethanol is not a hydrocarbon. It is a hydrocarbon. And when you burn ethanol, you do get CO2 out of the tailpipe. Not as much as you do with gasoline. But ethanol and producing ethanol in Latin America is, it's a niche market. It's a niche supplier. 90% of all the automotive ethanol in the world is produced by Brazil and the United States, and that's pretty much where it's used.
Okay, so we've been talking about natural resource investment and infrastructure, and I'd like to go back to a topic that everybody was talking about a couple of years ago too, and you couldn't have a conference like this where China didn't come up in every conversation. And so far, it really hasn't come up. And Eric, I'd like to ask you to start talking about what happened to that $100 billion that we were promised for Latin America investments? Has it happened? Are the Chinese investing? And if so, where? And are you guys involved with them?
Yeah, so, wow. So
Don't sound too excited with the question.
Where to begin here? Look, the reality is that China is an important actor in Latin America, and it's undisputable, right? I dug up my old stats fact book, and interestingly, trade since the year 2000 between China and Latin America has increased 2,000%, right? That's not insignificant. And since 2014, even since 2014, right, China is still Latin America's largest source of foreign direct investment. The challenge of analyzing the foreign direct investment flows from China to Latin America are compounded by the fact that you don't necessarily know, the official figures don't show you that if China invests in a BVI company that invests in a Cayman company that ultimately goes into Latin America, those aren't counted, right? So, the amounts that we see that may seem smaller than expected may not be, because there are a lot of legal and accounting issues. But look, at the end of the day, 72% of exports from Latin America, 72% are minerals, oil, soybeans, and oil seed type products, and I think that the jury's out as to how healthy the relationship is between these two regions, right? At one level, you see Latin Americans, rightly so, complaining that they are deindustrializing, right? In essence, Brazil produces iron ore, and it goes to China only to be converted into a car that ends up going back to Brazil, right? And inexpensive Chinese exports are hurting the Brazilian, say, shoe manufacturers or whatever. And it's a valid point. What I would argue is that Brazil and other countries need to up their game, right? I mean, if you have labor laws that are very onerous, if you have a tax scheme that's unintelligible, if you have logistics problems and so forth, you're not competitive globally. So it's to some degree the onus belongs to Latin American countries to become more competitive. Now, having said that, China too has its own valid points, right? China's saying, we didn't win the geological lottery. We don't have certainly enough arable land, oil, minerals to be able to feed our people and to grow our economy. So we actually need to go to Latin America to do this. So I'll finish by saying that I think, that's the impasse, right? Inevitably, what's going to happen is that China's going to realize that it may make sense to add a lot more value to the products that they buy in Latin America. And I'll give you an illustration, right? It doesn't make sense to buy soybeans in Brazil only to export them on a ship, speaking of carbon footprints, to feed them to cows in China to feed the people, right? On land that's not that's scarce in China, on land that's water deficient. Wouldn't it make more sense for the Chinese companies to invest in cattle farms in Brazil or Paraguay or whatever, and then you export the final product to China? So you're going to start seeing a lot more of these sensible approaches where you're not just taking the raw materials out of the ground, sending them to China and going back, but rather investing in Latin America and sending the raw material, the final product to China.
Let me add to that. If you take a look at the deals that China has got with Venezuela and Ecuador, a couple $2 billion to each in exchange they can pay back for oil. I asked a friend of mine who has spent most of his career in refining logistics, what does it cost to transport a barrel of oil from Venezuela or Ecuador to the Gulf Coast of the U.S. versus to China? Does this make any sense? And he looked it up for me, checked it out. He said, a barrel of oil, landed cost is 50 cents to go from Venezuela to the Gulf Coast of the United States, 50 cents a barrel. To move that same barrel of oil to China is approximately $10. So what does that tell you about the deal that China may have cut with Venezuela and Ecuador and how much they're getting for that oil? I can guarantee you they are not getting anywhere near for that oil what they would have gotten had they exported it to the United States. So the deals, these deals of money for oil that China, and you quite rightly point out, China understands it needs a secure, diversified supply of oil from around the world, are very, very much to China's advantage.
You know, what Eric said is, in the long run, these are two sort of unlikely mates that are forced into a marriage of convenience. And in the long run, China and Latin America will have to do business together. And the last 10 years have been sort of a honeymoon period where they're now sort of taking stock and realizing all the mistakes that were made. And a couple of things, I went to China twice. Both times before I went, I sat down with Eric and picked his brains and his Rolodex. And I talked to people in China, and a couple of things were pointed out to me. Number one, China, although the private sector is an important engine inside the Chinese economy, when it comes to outbound investment, it's still dominated by state-owned enterprises. And yes, they have commercial objectives in mind, but they also have political ones. And so what drives them and the decisions they make is different, fundamentally different than other big companies around the world. But we're all aware of the purge, the anti-corruption purge that's going on in China. It started with the new premier's entry, and it continues. But what has not been spoken about a lot in public domain is the fact that as abusive as corruption was in China, it was the overseas deals where the really rampant corruption was. When you invest in an oil field or mining rights, there's huge latitude to overpay for those assets and to channel monies through whatever offshore jurisdiction back into the hands of Chinese officials as well as their host country officials. And that went on in massive numbers, but it's all being kept under close wraps. And what's happening is the country managers of different Chinese mining interests are being quietly called back to Beijing to answer some tough questions. And what this has done is it's sort of put a quiet pall over the outbound investment plans, just as there's a quiet pall over a lot of investment activity in China right now because of fear of making the wrong move or fall. You know, the private jet market in China has fallen through the floor because nobody wants to be seen on a private jet. Macau is down 50%, its gambling casinos, because nobody wants to be seen as being opulently spending
Luxury
dirty
hotels,
money.
Bentley sales, they're all down.
So the new China-Latin America strategy is changing, and it's changing in part because of that. It's also changing because China went through a massive infrastructure spend as a sort of counter-cyclical measure after the financial crisis. As tough as the financial crisis was in this country, it really hurt trade finance in China and hurt exporters for about 12 months, causing massive unemployment in China back in 2009-10. As a counterweight to that, the Chinese government deputized many dozens of cities in China and said, go out and build subway systems and low-income housing and road systems, and they spent massive amounts of money, which drove up the price of iron ore and other commodities. Well, that's now, they can no longer sustain that. But they have this massive construction and engineering sector that's out of work. And so they're looking for new projects around the world. So Chinese investment increasingly, and we're starting to see it in Latin America, will be in these sort of large budget infrastructure projects, usually designed to help bring raw materials more efficiently to China. But you will see more and more of these projects funded. Some of them don't make a lot of sense, but they employ, and that's really also what's behind Chinese aid monies. So just as the Americans and the Dutch and the British and the French in the past extended aid around the world really as a way of employing their own engineering companies, the Chinese are doing the same. The other is that Chinese labor costs are going through the roof. There is no low-cost manufacturing left in places like Shanghai. And even on coastal China, it's getting expensive. And so if
John, what does that mean, by the way? I mean, if you compare Latin American labor costs with Chinese...
So it's now to the point where the cost of producing a good in Mexico and putting it in a store in the United States is now cheaper in a lot of different categories than it is from China. And so the Chinese companies that have worked hard to secure those contracts with U.S. customers, rather than lose that business, are shifting production to Mexico. It's really easy to disassemble a factory in Shenzhen and move it to northern Mexico or Guatemala or Nicaragua or Honduras and set it up there and maintain that U.S. client rather than risk losing the client. So we're going to see more and more of sort of maquila-style manufacturing being owned by Chinese.
That's one of the.
Ed, just give me a sec. Everybody's on notice. You can raise your hand. I'll get you a microphone. Everyone can start asking questions. I have a bunch more on Cuba, on competitiveness, on trade deals, and so on. But you're all welcome to jump in. So just put up your hand.
What John just said, I just wanted to comment, is an extremely important point, because in terms of the impact of these low oil prices, the cost of transportation and transporting these things from one point to another has gotten much cheaper than it was in a high-price oil environment. And even with that, given the higher costs in China, it's still more competitive to bring those things back here and manufacture it here than it is to transport it across the world.
Hey, for those of you that have heard of something called the One Belt, One Road initiative, could you raise your hand? One person. All right,
Two.
you guys,
Another
two
one
people.
back there.
All of you should
I hear
Google
three.
this immediately on your phone. This is momentous. China has embarked on arguably the largest trade corridor in the history of the world, and trillions of dollars are going to go into it. It's essentially a trade corridor that includes logistics, it includes finance, it includes a number of things, and it's going from China through Central Asia, through Europe. That's the one road portion of it. The one belt is going through Southeast Asia onto Europe. You know, there's a lot going on between China and its neighbors. And again, I don't want to, you know, overstate the importance of this, but this is the single largest infrastructure trade scheme that's ever been devised in the history of the world, maybe even greater than the Roman trade routes. So,
Okay, there's something big going on called the Trans-Pacific Partnership as well, and the Pacific Alliance was a big deal a few years ago. We haven't heard much about that recently. I'd like to ask you about the trade corridors opening up for Latin America and what impact that might have, and are there any other trade pacts on the table for Latin America?
Well, if we're really ready to fall asleep, we can talk about trade. I don't know how many conferences I've been to in this town where we talked about the promise of trade only to be disappointed. But I'm going to throw one more promising notion out there. The Europeans and Mercosur have been trying for, 15, 18 years to sign a trade pact. And they've come close a couple of times. They were very close a year ago. Then, a little problem got in the way called Argentina with a non-convertible currency and and political issues at home. Well, with Macri in power and possibly the prospect of moving ahead without Venezuela, which is now a member of Mercosur, we may see a trade pact there. There's certainly a need in Brazil and Argentina to revive their economies, to take advantage of what will be cheap currencies once Argentina floats its currency. And exporting to Europe will be a sensible, area of growth potential. The Europeans seem just as keen as they were as ever to go ahead with a deal. Getting privileged access to Brazil that the Americans don't have and others don't have would certainly be a cap in their feathers. So I think that's an interesting trade opportunity that's out there. The other thing that's kind of exciting is the Alianza Pacifica, which is really not a trade deal. It's often sort of touted as a trade deal, but really it's way more ambitious than that. In fact, between those four countries, they already have free trade agreements. They already have free trade agreements, all of them with the States and with Canada and several of them with Europe. It's really about going much beyond trade and in pursuit of something that the Europeans have achieved, but without a single currency. They understand the pitfalls of a single currency when you have different levels of productivity and efficiency in these member countries. but they're talking about tying together and opening up and sort of standardizing the norms of many different industries so that you as an investor who invest in production in Peru can have easy access with your products automatically in the other member countries. And that's something that our existing trade agreements don't necessarily provide. So in other words, you may certify your product for Brazil, but that doesn't mean under Mercosur that your product is certified for the Argentine market. The Alianza Pacifica would pursue that along with all kinds of other areas of integration. So it is an interesting experiment. It's homegrown, even though it's a blueprint from the American trade negotiations. It's considered politically to be homegrown, and that's important in its ability to maintain political support in those countries as well as potentially export it to other countries in the region.
An important element of that Pacific Alliance, by the way, is the unified stock markets in those 4 countries.